You know what I hear from contractors all the time? Luis, I'm bonded. Cool, but that doesn't necessarily mean that you're protected. And honestly, this is one of the biggest misunderstandings in construction. A lot of business owners think that surety bonds work like insurance. It doesn't, and it's not even close. And if you misunderstand this difference, you can end up personally paying for claims, lawsuits, damaged property, injuries, or even contract disputes that maybe you thought you had coverage for. So in this video, I want to break down for you in plain English. No insurance jargon, no corporate nonsense, just real world contractor talk. We're going to cover what insurance actually does, what a bond actually does, why bond claims can come back on you personally, and why having just a bond can leave your business dangerously exposed. Because quite frankly, I've seen contractors learn this the hard way, and usually after a claim. All right, so why is this so confusing in the first place? Because bonds and insurance look similar from the outside. You pay money, you get paperwork, someone requires it before you start work. So naturally people assume, well, it's covered. But the purpose behind them is completely different. Insurance is designed to protect you from financial loss. A bond is designed to protect someone else from you not completing your work. This is the easiest way to think about it. Insurance protects your business. A bond guarantees your performance, compliance, or payment obligations. Huge difference. Are you with me so far? Honestly, a lot of contractors don't realize this until a bond claim hits. Then suddenly they're finding out, wait, I have to pay this back? Yeah, most of the time you do. Let's start with insurance first. Insurance is all about transferring risk, meaning something bad happens, the insurance company steps in financially based on the policy terms. For example, you back your work truck into somebody's car. Commercial auto is going to pay up. A customer slips on your job site. General liability may help cover that. One of your employees gets injured on the job. Workman's comp may respond. A storm damages your building. Commercial property insurance steps in. The whole point is that insurance is built to absorb financial risk that could otherwise destroy your business. Now, obviously, every policy has limitations, exclusions, deductibles, all that stuff. But at its core, insurance exists to protect the insured from a covered loss. That's the foundation. Now, let's talk about bonds, because this is where the misunderstanding really happens. A surety bond is basically a financial guarantee. It says the contractor promises to fulfill their contract obligations. That could mean finishing a project, following city requirements, paying subcontractors, following licensing rules, or complying with a contract. Now, here's the important part. A bond involves three parties: the contractor, you, the customer or government entity requiring the bond, and a surety company backing the guarantee of the bond. If the contractor fails to meet this obligation, the surety company may pay the claim initially, but that does not mean the contractor is off the hook. That's where bonds and insurance are very different. With insurance, the carrier assumes the risk. With bonds, the surety expects reimbursement, meaning if they pay out, they're usually going to come back to collect from the contractor, you, the insured. That's why most bond agreements include an indemnification clause. That basically says, if we have to pay, you agree to repay us back. That changes the entire relationship. Here's one super simple example. Let's say the city requires a contractor license bond. A contractor pulls the permit, takes a deposit, and starts work. Then disappears halfway through the project. The customer files a claim against the bond. The surety investigates. If they determine that the contractor violated the bond obligation, they may compensate the damaged party. Sounds great, right? Except now the contractor owes that surety company that money back, including any legal fees, investigation, all kinds of stuff. So unlike insurance, a bond claim doesn't necessarily protect the contractor financially. In many cases, it creates a debt obligation. That's why I always tell contractors, a bond is not a substitute for insurance, ever. Let's talk about the dangers of cheap bond-only setups. And honestly, this is where I see a lot of contractors get in trouble, especially newer contractors trying to keep startup costs low. They'll get a minimum bond requirement, but skip important insurance coverages because technically the bond got them approved to start work, but that doesn't mean that they're protected. Let's say an employee gets injured on the job, a trailer gets stolen, a customer claims property damage, somebody alleges negligence, there's an auto accident, tools get stolen from a job site. The bond usually doesn't solve these problems. That's where proper insurance matters. And unfortunately, a lot of contractors don't discover this gap until something happens. Let's all agree that that's the worst possible time to learn that. Let's be real, claims don't care that you're trying to save money, and certainly lawsuits don't care. Now, if you're a Texas contractor, this matters even more because Texas has a huge range of contractor setups. Some guys are operating as solo operators, with subcontractors, with crews, using personal vehicles for business, doing side jobs, taking on larger commercial projects. And depending on what kind of work you're actually doing, your exposure can change fast. A handyman's risk profile looks different from a roofer. A painter's looks different from an electrician. A general contractor's looks different from a concrete contractor. That's why cookie cutter setups can be dangerous, because just checking the bonded box doesn't mean your business is actually protected correctly. Now, obviously, every contractor is different, but this is usually where the conversation expands beyond bonds. Things like general liability, work comp, commercial auto, inland marine for tools and contractor equipment, umbrella coverage, professional liability in some situations, cyber coverage if you're handling customer data or payments. And here's the thing. I'm not saying that every contractor needs to have every single policy from the jump, but I am saying you should understand the difference between meeting the minimum requirement and actually protecting your business. Those are not always the same thing, not even close. Honestly, here's the bigger issue. A lot of contractors buy insurance and bonds purely on price. And I get it, running a business is expensive, but the cheapest setup on paper can very quickly become the most expensive come claim time, especially if nobody explained exclusions, classifications, subcontractor issues, policy limitations, or what your bond actually does. That's why education matters. The reality is that contractors are usually really good at their trade, but nobody ever teaches them the risk side of the business. And unfortunately, those hard lessons usually come during audits, lawsuits, cancellations, or claims. So if you remember nothing else from this video, please walk away with this. Insurance and surety bonds are not the same thing. Insurance is designed to protect you from a covered financial loss, while bonds are designed to protect someone else from you not fulfilling your obligation. And if a bond gets paid, there's a good chance you're gonna owe that money back. That distinction matters, especially if you're building a serious construction business in Texas. If you've got questions about your contractor insurance setup, or you're not really sure where the gaps are, reach out to us here at Leal Insurance Services. We'll help you look at the full picture. Not just whether or not you're bonded, but whether or not your business is actually protected. And if this video helped clear anything up for you, share it with another contractor. Because trust me, this misunderstanding is way more common than people think.